Funding through the life of your business. The status of a business is the stage where it is in its life cycle. Some businesses never get past the first stage. A business's status defines how it can get funding. Try for the wrong kind of funding for a business's status and expect to be turned down. Business statuses or stages generally are as follows. Seed or startup. 6 months in business. Venture capitalists call this growth or Series A. 12 months in business. Venture capitalists usually call this Series B. And expansion or profitable. These generally correspond to funding stages. What are the actual funding stages? Seed funding is the earliest round of financing needed to prove a new idea. Funding often comes from angel investors or, lately, equity crowdfunding. Startup is when early-stage firms need funds for their expenses from marketing and product development. Growth, Series A round, is for early sales and manufacturing funds. This is typically where venture capitalists enter the picture, if at all. Series A is basically the first institutional round. This is where most companies will have the most growth. The 6-month benchmark is a rough estimate. Some companies are in Series A after a year or more. So what are the funding stages? Second round or Series B is for working capital for early-stage companies which are selling product, but not yet turning a profit. Again, the 12-month benchmark represents an estimate as some businesses will be at this stage after a few years. And expansion or profitable is what venture capitalists also call mezzanine financing. This is expansion money for a newly profitable business. Business survival rates vary. According to the SBA, about 2/3 of businesses with employees survive at least 2 years and about half survive at least 5 years. As one would expect, after the first few relatively volatile years, survival rates flatten out. See www.sba.gov/sites/default/files/business-survival.pdf. Therefore, a lot of business can potentially make it to expansion if they are funded properly. Startup funding comes with certain challenges. A startup can't depend on inventory or equipment. An entrepreneur might have 401k or stocks for collateral, or they might be able to use another's 401k or stocks. They can also try angel investors or VCs. A startup might qualify for grants from the federal, state, and local government. Unsecured business credit lines are another option. A business owner can use a guarantor. Some alternative lenders offer unsecured bank lines of credit. Another option is crowdfunding. How can startups help themselves? Startups can help themselves by building business credit, using Square and PayPal, using FundBox, and building a history with any or all of these companies. 401k financing is one way to get started. An entrepreneur can use an existing 401k or IRA as collateral for business financing. These are IRS-proven strategies with no tax penalties. Plus, a business owner can still earn interest on their 401k and pay low rates, often less than 5%. Close and fund in less than 3 weeks. A business owner can get up to 100% of what they can roll over within their 401k. There are no consumer credit score requirements. Even a startup can be approved. An entrepreneur will not need a tax refund or a bank statement review. The business can get approved for a loan equal to 100% of the value of the 401k. The idea is that the business owner is investing the 401k in their own business. This is instead of buying stocks in other businesses. There are no tax ramifications. Securities financing is another possibility. A business owner can get financing regardless of personal credit if they have some kind of stocks or bonds. They can also get approved if they have someone who wants to use their stocks or bonds as collateral for financing. Personal credit quality doesn't matter. There are no consumer credit requirements for approval. Angel investing is another option. Angels are informal investors. They generally invest in the start of a company. This is often in a swap for equity. They can even invest via a crowdfunding platform. Companies can connect to affiliated angel investors by just asking. Companies can connect to unaffiliated angel investors much the same way they can connect to others who can help them or who they don't know or don't know well through business brokers, cold calling, advertising, or intermediaries and networking. Venture capital is another choice. Venture capitalists will give money to help build new startups. If the VCs believe a company has both high growth and high risk potential, these tend to be fast growth companies with an exit strategy already in place. Venture capitalists will often want to recover their investment within 3 to 5 years. They also often want to own a large piece of the company, if not a controlling stake. Venture capitalists look for a strong management team, a large potential market, and a unique product or service with a strong competitive advantage. VCs also seek opportunities in industries they have familiarity with and the chance to own a large percent of a company because they want to be able to influence its direction. Grants can be another way to go. HUD, Housing and Urban Development, is an agency which hands out grants. If a business isn't related to housing or city development, then it won't be approved. But if it is, then search for HUD grants at https://portal.hud.gov. NOFAs, Notices of Funding Availability, include the contact where to send an application. If applying for more than one HUD grant, it has to be a separate application under the correct NOFA. For more rural industries, try the USDA. Find them online at www.usda.gov. The USDA doesn't just give grants to ranchers and farmers. They also give grants to waste management companies, energy companies, and housing preservationists and providers. A state or local government might provide grants. Offer a partnership to the state, city, or town. Ask for local government support for a project. Try to appeal to a specific local government need. A grant needs to have a grant proposal. These operate a lot like business plans. A local address is generally a bonus when applying for a grant. Write a clear and short cover letter. Don't ramble and get to the point quickly. Check delivery requirements, mail or in person, and follow them to the letter. Unsecured business credit lines can be another way to get funding. Unsecured business financing is another option. Use the entrepreneur's assets as collateral. This can be personal assets like a 401k or business assets like equipment owned outright. A business owner can get 0% business credit cards with stated income. No financials are required. Get up to $150,000. The business owner will need a credit score of 700 or better. This is not a good option for an entrepreneur with poor personal credit. Unsecured bank lines of credit can also work. Some alternative lenders are now offering lines of credit for $50,000 to $150,000. This is a minimal documentation program. They will usually only want tax returns instead of all income documentation. If over $100,000, the business owner will need to supply a P&L and balance sheet. These take much less time to close than conventional bank lines of credit, with 30 to 45 days to close and fund. Rates are low for these. They often run from 7 to 10%. The approval amount is usually 10% of annual sales per their tax returns. A business owner will need an experience score of 700 or higher to qualify. Crowdfunding can work for certain projects and industries. This comes via a platform like Kickstarter or Indiegogo. It gathers money from a lot of people instead of one big investor. If the crowd likes the idea, they may decide to donate to a project. A good pitch is vital for success. Generally, crowdfunding doesn't need to be paid back, but read the fine print. Many crowdfunding platforms make an entrepreneur give all of the funding back if they do not make their goal by the campaign's end. Indiegogo has a flexible funding option. Platforms take a percentage of donations. Get donors excited about donating. Evoke emotions in them. The most effective feelings are urgency. They must donate now. Novelty. A product or service is new or the spin on an existing one is new. Scarcity. They can't get it anywhere else or it's running out. And the cool factor. The product or service is cool and has cachet. Building business credit is always a smart idea. If a business owner doesn't have a good enough FICO score to qualify for some of these options, then it's time to start building business credit. But they should be building business credit even if their FICO score is stellar, because business credit can help a business at any stage. Vendor credit is a proven means of getting started in building credit as vendor or trade credit. It is often very easy to get. There often is no consumer credit pool. A business should get its first 5 to 8 credit accounts through vendor credit. Store credit comes next. If there are 5 to 8 trade lines reporting, then a business can move on to revolving store credit. This is places like Walmart. Sometimes in order to establish good store credit, a business has to buy some things it does not need. Consider donating those items to charity. Fleet credit is next in line. If there are 10 revolving store credit lines reporting, then a business can advance to the next step in building business credit. Fleet credit comes from places like Chevron. It is a credit card which helps a business maintain a set of vehicles. These are usually fuel cards. They can be used to buy fuel, repairs, and maintenance. Keep going. Work toward 10 to 14 or more trade accounts. Cash credit is the next step in building business credit properly. If there are 14 fleet credit lines reporting, then a business can move on to cash credit. It is from companies such as MasterCard. It's accepted in a lot more places. Good business credit will help a company get loans in the future. 6 months in business is a significant milestone. One option that opens up is FundBox. They offer invoice financing. They don't buy accounts receivables for a percentage of the money owed. Instead, they finance the full amount in the form of what is essentially a loan. Then the company will pay it back as customers pay their invoices. Fees start at 4.66% of the amount drawn. FundBox offers business lines of credit. A company can get a line of credit up to $30,000 within 1 hour. A business can get up to $100,000 with supplied financials. There is no personal credit score requirement. They just want to connect to the business bank account. Go to FundBox at creditsuite.com/FundBox. Square and PayPal are more choices for companies in business for half a year already. Both offer loans. There is no personal credit check. This is an option when the startup is just starting to become profitable. Both options are dependent upon sales. Square offers loans for $500 to $100,000. Eligibility depends on a company's sales history with Square. Hence, this is not for brand new startup companies. See squareup.com/capital. PayPal offers a maximum loan amount of up to 30% of annual PayPal sales. A business can get $5,000 to $500,000. A company must be in business for at least 9 months. See paypal.com/us/webapps/mpp/PayPal-business-loan. How can companies in business for 6 months help themselves? They can help themselves by not overdrawing accounts, making consistent deposits, and keeping bank balances high. 12 months in business is an important milestone. A company in business for a year has more options. One is merchant cash funding. Another is revenue lending or revenue financing. Businesses can help themselves by not writing off all profits at the end of the year. A merchant cash advance is a lump sum payment. The business pays it back with a percentage of future revenue. Startups don't qualify because they typically don't have revenue or enough revenue. Revenue lending is a loan where repayments are based upon a percentage of a business's revenue rather than a fixed amount. Revenue-based financing or royalty-based financing, RBF, is a type of financial capital provided to small or growing businesses. Investors put capital into a business in return for a percentage of ongoing gross revenues. Businesses showing a profit have made it to the big time. With tax returns, there are more choices. There are lines of credit and term loans. Tax returns also mean a company has some time in business. The SBA loans might also be an option. A line of credit is an agreement between a borrower and a bank or private investor that establishes a maximum loan balance that a borrower can access. Investopedia says a term loan is a loan from a bank for a specific amount that has a specified repayment schedule and a fixed or floating interest rate. Mortgages, car loans, and student loans are all non-commercial examples of term loans. Businesses can help get SBA loans by accumulating assets. Account receivables are common collateral. They need to let customers pay them through terms. Let's recap. Business stage defines which funding options are available. Startups can get 401k or securities financing, angel investors or venture capitalists, grants, unsecured businesses, LOCs, and crowdfunding can also work. Building business credit helps out here and pays dividends later. More seasoned companies will qualify for Square or PayPal loans. They can work with FundBox for lines of credit or invoice financing. Other options include merchant cash financing and revenue lending. And finally, building business credit can help a company at any stage. Contact us today to learn more about funding through the life of your business.